What if I told you that everything you've been taught about DSCR loans is costing you thousands and maybe even your future deal? In the next 5 minutes, I'm not going to talk about theory. I'm going to talk about practical strategies about DSCR loans that right now investors are getting wrong. My name's Ben, and I've closed a lot of DSCR loans in the past 3 years. And I'm going to highlight 3 common mistakes I've seen almost on every other deal that most investors right now are making. So today, I'm pulling back the curtain on DSCR loan strategies that banks don't want you to know about, and I'm going to go over the exact blueprint on why some investors are successful with DSCR loans while others are not and they can't scale and grow their portfolio. And the first mistake is something that investors don't even know that they're making. But before we get into that, if you don't already know what DSCR loans are, I'm going to quickly explain it. If you do, you can just skip ahead. DSCR stands for Debt Service Coverage Ratio. Okay. The way it works is that for investment properties only, they don't verify personal income or personal debt. It's a really powerful tool and loan program to let you scale your portfolio. Because think about it, if you have 5 or 6 mortgages, right, or a couple car payments and other debts, at that point, it gets really, really hard to finance the next deal. So this product was created to allow investors to continuously finance that next deal. The way it works is, let's say you have a $1,500 mortgage payment and you want to buy a single family house, right? It's a good investment property. You think you'll do well with it. Great. With the PITI, principal, interest, taxes, and insurance, our mortgage is $1,500. What that means is that when the appraiser is going to come out to the house, he's going to do 2 things, right? He's going to assess the value of the property for the lender, because of course it has to make sense. And he's also going to assess the rental income. Now, what lenders typically do during the loan process is they're going to ask for lease agreements. Now, they'll take the lesser of the lease agreement or what the appraiser says the rental comps are for that area, for that house. We take the lesser of the two and we use gross rents. Okay. So here's an example of how that breaks down with an actual deal that I just closed. Okay. So let's say we have a property that's $250,000. All right. The proposed loan amount is $200K. Now, these DSCR loans start with 20% down. That's how much is usually required to purchase a single family home. Now, this goes up to 4 units. You could do 20% down, but let's say the rate is 7.5%. We're at a 30-year fixed mortgage. As a side note, there are interest-only options. There's even a 40-year option. So there are some creative abilities to be able to mess with that payment or drop that payment a little bit if we need to. But let's say the gross rental income is $1,500. We're going to look at your real estate taxes. So monthly it's $200, and then the hazard insurance is $110 a month. Okay. Our total subject property expenses is $310. This is for the lender. This is very important. We don't look at utilities, garbage removal, or disposal. We're only looking at taxes and insurance. That's it for the expenses for the loan. Okay. Now, the monthly mortgage payment is $1,398. So what we do is we take the property expenses plus the mortgage payment, and that gets us this 87% number. Okay. What that number is the DSC ratio. Okay. That's what we look for. Now, here's the problem though. Notice how it's 87%. We need that number to be at 100% for the loan to qualify. Okay. This is the mistake that investors make all the time. They see this and they say, oh, loan's dead. We're screwed. Okay. Here's the thing. You actually have some options when you're dealing with this kind of ratio. All right. Option number one is you could either try doing a 40-year mortgage or a 5-year prepayment penalty. Having more prepayment penalties, I'll explain a little bit, like gets you a lower rate. So lowering the rate is a good option to lower that monthly payment. 40-year interest only, you could try that. The other option is the no ratio program. So people don't know this, but DSCR loans have a no ratio like avenue. The only thing is with that, sometimes you have to put more money down. Sometimes you need to restructure the loan, but just know that most investors give up too easily because they think that, oh, the loan won't work. Well, believe it or not, we have a lot of options, especially as lenders. It's important to figure out what those options are. Okay. Now here's another example of it working. Let's say you're buying the same $250,000 house. You're putting 20% down with the same rate, same terms. Now look, the rental income is $1,750 a month, same taxes, same insurance, right? Expenses are the same. This time our ratio is 102%. This is great. Okay. This is what you want. If you want the best interest rate on the DSCR loan, I'm going to tell you right now, you want to go for a DSC ratio of 1.25%. Okay. 1.25, or like in this case, we have it at 102%. So it's a little bit over, but you want it at higher than that at a quarter, and that's going to give you the best terms of the loan. Now, if you're finding value in this video so far, don't forget to subscribe. I do a lot of creative financing and investor loan programs. So if you have any more questions, you can just reach out, but click that subscribe button so you can get more content like this. All right, so moving on, we have the important factor, that the second mistake that all investors miss, and that they really come to me surprised because the previous lender or whoever they talked to didn't talk to them about this, and that is prepayment penalties. So one of the catches with DSCR loans is that most of them have prepayment penalties, okay? The way prepayment penalties work is they have a fixed percentage, okay? So for this, sorry, let me get my correct, okay. So the prepay is usually going to start out at 5% of the amount, all right? The way it works is they have 0, 1, 2, 3, 4, or 5-year prepayment options, all right? I'll explain in a second what that means. Now, these are the states that it's not allowed in, all right? And then you'll see terminology like must buy out. Like, what does that mean, to buy out the prepayment penalty? Well, I'm glad you asked because I'll explain it in this next part. So an average prepayment penalty structure for DSCR loans works like this. You have a 5-year, you have a 4-year, you have a 3, and then you have a 2, okay? The way it works is you have to pay a percentage of the loan amount when you pay off the loan, depending on the year. If you want the best interest rate, you're going to do a 5-year prepayment penalty, or you could do 0-year prepayment penalty, which means there's no prepayment penalty. You can pay it off whenever, but then you're going to get a higher rate. So you have to ask yourself, what's more important? Do I want a lower rate, no prepayment penalty, or do I want a longer prepayment penalty, but then a lower rate? Most of my clients usually like to opt in for the 4 or 5-year prepayment penalty because they know, hey, I'm not going to pay off the loan. We'll just get a nice lower interest rate so I can cash flow. All right. Some things to know here in Illinois: if the loan has a rate that's greater than or equal to 8%, it has to close in an entity, meaning it has to close in an LLC. Most DSCR loans can close in an LLC. Heck, they could even close in a series LLC. That means you have an umbrella LLC, right, that owns all these other little LLCs under it, okay? That is possible if you want to do that, but just note that prepayment penalties in Illinois, New Jersey, and other states sometimes can be a little bit tricky, all right? Now, if you are buying the property as an individual, the prepayment penalty is not allowed. So only applicable if you're buying in a business. So now you have the rental income figured out and how prepayment penalties work. The third and final mistake is the last one that I think really ticks me off, because I actually see this happen more often than not. And that is that bad lenders slap on fees last minute, okay? And here's what I mean. When you do a DSCR loan, or any loan for that matter, you're usually going to get what we call a loan estimate, okay? Now, this loan estimate is going to be a 3-page document that's going to break down all the fees of your loan, all right? Now, my thing is giving me problems here. Give me a second. Okay. So this is our loan estimate. Okay, you're going to see this a lot if you're an investor. You've already seen this several times, right? But this is the box that lenders can control. All the other boxes here, section B through H, is third-party fees. We don't really have a control over how those fees work, okay? That's a first and foremost, just know that, okay? The next thing is, a lot of the times what I'll see is lenders will start off charging maybe, let's say, 1% or 2% or even 3%, right? Depending on the deal in the beginning, okay? And every lender is different, but let's say we go to a lender and they're like, okay, I'm going to give you a 2% origination fee, which is pretty standard for this loan, okay? What happens is a week before closing, they'll change their mind, say, hey, you know what? Instead of that 2% fee, we're actually going to do a 4% origination fee, all right? And you might be thinking, well, how's that even legal? Is that allowed? Well, in the DSCR loan world, it's a little bit different than a conventional or FHA loan. So technically, these guys can sometimes get away with it. So last minute, they'll charge you 4%, and now you're stuck with this purchase transaction, and you only have 2 options. Either A, you back out of the deal, or B, you pay the fee and you just go with it, all right? You might be thinking, well, Ben, why don't you just go find another lender? And it's like, you can, but sometimes sellers don't like last minute screw ups, and they might go with someone else. Right now in this market, it's really competitive. So just know in the future, like, this is a big thing. It's a trust thing. That's why my clients, they trust me. They know that, hey, if we're going to do a deal, I'm going to be upfront. We're not going to change anything. You want to make sure that section A, the lender fees, are not going to change or go astronomically high. I've seen guys lose a ton of money because of this mistake. It happens often. Look, DSCR loans aren't complicated. They're just misunderstood. Hopefully, by the end of this video, you've grasped what the basic strategies are to be able to leverage these loan programs to scale and grow your portfolio. But Knowledge without action is just pointless and entertainment. And look, I'm not here to dance and sing and entertain people. I'm here to really build value and help investors win in this market. So I'm going to ask you for three things. All right. First is save this video for future use. Second is if you want to start applying this today, I highly encourage you to do so because the market doesn't wait and neither should you. And then the third thing is if you have any questions on how to purchase your next property using this loan program, or if you want to take money out as well, I can help you through that. My team and I are great. This is what we do day in and day out. So I'll put my info in the description. You can book a strategy call or email and text us below. I'll see you in the next video. Hope this was valuable. Make sure to subscribe. Thank you.